There's a real concern, as has just been mentioned, that mine finances and specifically banks are currently disappearing faster than X-Factor contestants. But let's start by taking a quick helicopter view of the landscape. The macroeconomic environment. It certainly hasn't been a slow year on the news front. On a positive side, we've seen an unprecedented wave of political change sweeping through North Africa. Europe, it continues to dominate the headlines with the question on everyone's mind, will we see the breakup of the euro? A hugely politically charged question. Developed economies, they are no longer the growth drivers. We see high levels of debt in the West and unwillingness to deal with significant austerity measures, coupled with extremely accommodating monetary policy led by Mr. Bernanke, who has his printing press running over nameplate capacity. Emerging markets, they're of increasing importance. We see signs moving away from monetary tightening, which is very good. China is in the process of moving away from huge investment in infrastructure to investing in human capital. And that's education, healthcare, and technology. As financial expert John Malden neatly phrased it, China will affect every investment class on the planet for the next 100 years. The dragon is coming to lunch on Tuesday. The only decision you have to make is whether you and your money are going to be on the table or on the menu. The US dollar in the last few weeks has seen sudden strengthening, and it's correlated to what's happening in the international and global stock markets. US investors are liquidating positions and repatriating those funds back home, moving to the currency that's most liquid. It's a clear sign of the fear in the market. Finally, volatility, well, it's here to stay. As I say, change is inevitable, except from vending machines. And wrapping up the macroeconomic view, I'd like to end off with a silver lining, which is that in these depressed markets, a number of company valuations are looking extremely attractive. Just last week, we saw a swing to optimism. Central banks acting in a concerted fashion, and the ECB indicating funding the European banking system. Stability is simply in everyone's interests. Let's have a quick look on the commodity side. Prices have not been immune to the volatility we've experienced. However, when you look at the likes of gold, iron ore, copper, you see prices that are generating significant profits for producers, and they're still attracting investment into new mines. Demand for bulk commodities led by Asia and the developing economies is still there. And while prices across the general base complex are down, copper is still fairly firm. While investors are increasingly presented with options to invest directly in the underlying commodities, appetite for exposure to mining stocks remains firm. And you can see a number of mining companies in the general sector, although not looking fantastic, it's still outperforming developing market indices. As we stand today, the general uncertainty in the markets is wreaking havoc across the board. Take gold, for instance. It's a case of conflicting pressures. Worsening economic outlook and low real interest rates are positive for gold. However, investors are increasingly risk-averse and reducing their equity positions across the board. Looking behind us at the lending market, in 2011, we saw a number of financings for new mines and related developments. To mention a few, Discovery Metals financing their Boseto project, First Quantum Minerals financing Kevitsa, Base Metals, their Kwale project, Sandfire Resources, De Grassa, Vedanta Aluminium, a smelter, and Vietnam National Coal and Wickins Island financing a project and coal terminal respectively. Other transactions that are also worth mentioning include Goldcorp, who recently signed a 5-year, $2 billion RCF with a large lending group at fantastic terms. First Alpine took a $1.1 billion insurance loan to cushion against market fluctuations. We saw the strength of sovereign wealth funds, with Qatar Holdings funding European goldfields, $750 million. Private equity firms, they're also back in the natural resources space. KKR in a consortia, including 2 other hedge funds, and Itochu bidding $7.2 billion for the second largest LBO this year. Finally, in recent weeks, Xstrata, Newcrest, and Peabody all launched low-yielding bonds in the US market. Now focusing on the lender's position today and going forward. The European debt crisis has had a tremendous knock-on effect on the European banks, and many of them are key sources to the mining sector, notably the juniors. While a historic graph of LIBOR rates shows levels at 20 to 30-year lows, as experienced in 2009, LIBOR is no indication of the true cost of funding or borrowing costs to lenders and banks. A quick look at the CDS spread, a measure of credit default risk, indicates the increasing risk and thus cost of funding for banks. There is increasing pressure on the European banks to better their capital, to offset losses on loans, many of which are tied to the ailing European economy and governments. The reality is that lenders are now reining back their funding to core sectors and to core geographies. On the positive side, there are a number of banks out there, like Standard Bank, that remain active with liquidity, limited exposure to Europe, and are committed to the mining and metal sector long term. In addition, we've got export credit agencies, or ECAs, who maintain a strong source of funding with their deep pockets as they look to promote their country's exports and stimulate trade. Development finance institutions, or DFIs, maintain their development mandate and focus on a number of emerging market economies where many miners' projects are situated. Multilaterals, for example, IFC, they implement a consistent investment strategy, injecting early-stage equity into juniors and then providing follow-on debt funding, as witnessed in their recent early-stage $5 million investment into African Eagle. Is financing available? Yes. Is it readily available? That's the question. So what works in the new funding environment? It's important to understand all the funding options available and the latest developing trends. If we look at equity raisings, the blue column, we see they've performed pretty consistently over the last 2 years. If you move over to the green shaded column, that represents the loans, and you can see it's currently around 30% off 2010 levels. Analyzing the total loan volume in 2011, the big players in the market continue to dominate. And 4 companies, BHP, Xstrata, Barrick, and Glencore, represent 30% of the loan volume alone. With a month to go, loans are currently accounting for a lower percentage of overall funding in 2011, down to 39% from 50% a year ago, with the overall value around $90 billion. Now, traders and bankers have blurred the lines typically distinguishing their ability to provide debt, equity, and physical linked financing solutions. Monetizing the offtake has become increasingly important and a key weapon in the arsenal of the mine developer. There are several major mine developments on at the moment that have leveraged their offtake. Examples include Inmet with their $5 billion Cobra Panama project in Central America, They have South Korea's LS Nikko in, with an option to acquire 20% of the project, and Offtake. Similarly, we had African Minerals, who are looking to secure $1.5 billion from Shandong. In addition, we've seen the strategy of securing a strong JV partner, with the price to play being a commitment to deliver the lion's share of the project financing. Examples of transactions in this space include Quadra, tying up with Sumitomo, Marengo with NFC, and Capstone with Cores. While there are a number of financing solutions available, the product of project finance continues to provide real benefits over any other solution. You see, streaming deals and prepays are typically bilateral deals and work fine for smaller mines. However, for large ones like Oyu-Tolgoi or the original financing for Barrick's recent acquisition, Lumwana, you need a lot more cash than can be done bilaterally. So you need a watertight deal and structure that you can club. PF is familiar to the market, and the deep pockets of the ECAs plus the DFIs and multilaterals can be accessed. New additions to the funding sources are the sovereign wealth funds we've mentioned, as evidenced by Qatar Holdings financing for European gold fields, in addition to other private equity funds who are all focusing on the sector. So in a tough funding environment, what can companies do to secure financing? What follows is an action plan, and it's fairly straightforward. The sporting analogy here is fairly relevant. You see, top athletes get to the top and become experts by practicing the basics over and over. So let's start with commodities. Certain commodities will simply find it easier to raise financing. Your bulk commodities of coal and iron ore, precious metals, base metals, and uranium. Funding for the likes of diamonds, rare earths, some of the alloys, and steel-making metals and fertilizers is far more restricted. This is due to lack of terminal markets, which increases pricing risk, and also that's combined with less certainty on the demand and the supply side. Secondly, junior miners should consider the involvement of an advisor when looking to secure financing. It allows the management team to stay focused on the development of the mine and maximizes the likelihood of a successful close. Some miners want to ensure their advisor remains completely independent from the arranging process, whereas you have others who simply won't consider an advisor unless they're able to arrive at the end of the day with their personal checkbook. A compelling case in environments of evaporating funding availability. In addition, technical and legal consultants, as well as commercially minded lawyers, are a key part of any financing, with a technical review process typically being the rate-determining step to close financing. Aided by an advisor, a miner should have a clear understanding of the various funding solutions available, which can be targeted, both debt and equity, and a clear strategy of how and when to approach each source. As outlined earlier, these range from commercial banks through ECAs, DFIs, multilaterals, various off-takers, equipment financiers, funds, and royalty companies. Next, preparation for financing should be well advanced prior to final feasibility. This includes a thorough understanding of the project challenges and mitigation of any risks, e.g. transport logistics or supply of water and power. General lender requirements should also be understood, and this includes compliance with social and environmental guidelines, the need for an independent technical review, adequate contingencies built into estimates, and cost overrun support. Next, we have realism and benchmarking to peers. Companies need to be realistic on the quantum of funding or financing that they can raise, the timing required to do so, and importantly, be confident in benchmarking themselves to their peers. Should a real shortage of funding be prevalent in the year to come and liquidity evaporate, it will be increasingly important for miners to differentiate themselves. Miners need to be confident in their ability to demonstrate robust project economics and use conservative long-term assumptions for financing. Taking a quick look at the copper and the gold cost curves, we can see one of the reasons why lenders favor these commodities. On the copper side, 90% of the copper produced is at C1 cash costs of around $1.8 a pound, and all-in costs, including sustaining capex, around 2.25, well below the current cost of copper of $3.50. On the gold side, the current price is currently above production costs. However, gold miners in Ghana were treated to an unexpected surprise recently with the announcement of corporate tax and royalty threatening the overall economy or the economics of new mines. As for cost overruns I've mentioned, miners would have to be crazier than the March hare to believe that 10% is an adequate contingency. If the average Joe like me can't even revamp a kitchen on time and on budget, what hope is there for multi-million or multi-billion-dollar projects? Moving on to a well-planned financing strategy and coordinated execution, that's the key to a successful financing, especially when the PF product is targeted. A realistic timeframe for execution can be outlined by clearly defining the tasks involved and the scope of work for each of the players, understanding the critical path items. These tasks, as already mentioned, include the independent technical consultants review, the various lenders' credit committee and review processes, and finally, fallback financing options being outlined, as well as solutions to address cost overrun. And the final point, regardless of the funding solution, there is simply no way around the inherent risks in funding and developing a mine. The risks need to be identified at an early stage and will always need to be mitigated. While underlying mining sector risks do not vary significantly, their level of priority certainly does. The Ernst & Young annual report presents interesting observations when comparing 2010 to 2011. The report was released in August, and the 2010's top spot of capital allocation was taken by resource nationalism. Both years show skill shortage as the second key risk, and notably, capital project execution, including cost overrun, has jumped into the fifth slot. It's not surprising to see resource nationalism taking gold medal. Australia with its mineral resource rent tax, Peru with their windfall tax, Tanzania, US, China, Venezuela, South Africa, Ghana. It's no longer a list of which companies are proposing amendments, it's rather who isn't. As for capital allocation, dropping down the list, well, PKF's recent AIM sounding identified the availability of finance as the major concern of companies. And although it's a little bit dark out there, maybe we could quickly attempt some audience interaction with a show of hands. If we redid the poll today, who would put access to financing above resource nationalism as the top risk facing miners? Okay, fairly convincing argument then. I guess both risks are significantly important. Funding definitely is a crucial part, but the moves underfoot by governments, I think it's a reality of today. And both miners, consulting companies, lenders, various other forms of professionals in the industry all have a vested interest in involvement in trying to find more sustainable ways and guiding governments to solutions that not only uplift the population, but do encourage ongoing investment. Coming into land now. You may be wondering how these two drag queen comedians are going to wrap up and conclude. It's simple. It's a big old beauty contest out there. Funding may well become scarcer, however, it certainly won't disappear. And solutions are at hand for strong management teams with sound projects. It remains management's and board's priority and responsibility to develop sound financing solutions and strategies and to seek partners to match their funding requirements. So, don the lipstick and heels, and if you've got it, flaunt it.